Hi, everyone. Thank you for joining us. We are really happy to have you with us today for our webinar on the tax and legal considerations related to the new corporate collective investment vehicle regime, which will commence on 1 July. My name is Sean Cartoon, and I'm a partner in Arnold Block Leibler's tax team. I will be presenting today's session together with my colleagues, Jason Van Grieken, who's a partner in our commercial team, Noah Lipschut, who's a commercial lawyer, and George Basil, who is a lawyer in our tax team. First, I would like to begin by acknowledging the traditional owners of the lands from which we are all joining this webinar today. I'm speaking from the lands of the Wurundjeri people of the Kulin Nation, and I pay my respects to their elders past, present, and emerging. Now, for some quick housekeeping, we encourage you to send through questions at any time throughout the session. To send a question, please use the Q&A function at the bottom of the Zoom screen. I also wanted to flag with you that today's session will be recorded, but none of you can be seen. So with that in mind, let's dive into the world of CSIVs. So as we would all know, the Australian managed funds industry has largely been dominated by investment vehicles based on the use of trusts as the preferred legal and tax structure. It's other than for in a limited sense for venture capital with the specific VCLP and ESVCLP regimes. It's pretty much all unit trusts that are managed investment schemes, MITs, AMITs. That's the world we've been living in for the last decade or so. However, trusts are well known to Australian investors, but they are often approached with caution by investors in foreign jurisdictions like the US. So from 1 July this year, the CSIV regime will commence with its regulatory and tax frameworks all kicking in. This new type of corporate collective investment vehicle, it's really been developed to internationalize our managed funds industry, add another tool to the fund manager's toolkit, ultimately to attract foreign capital for Australian investment purposes. George, if you go to the next slide, please. So what's the purpose of today? Really, we've been studying the legislation, and we've started having some really interesting discussions with clients, a number of whom are quite keen to explore this structure moving forward after 1 July. So really today is about starting, we're going to assume no one knows anything about CSIVs, and we're going to take you through the basics from the legal perspective and also from the tax perspective. And we'll build on some of the concepts, but today's really just to get things started in the world of CSIVs ahead of our 1 July kickoff date. So with that in mind, George, I might ask you to tell us some of the objectives and benefits.
Thanks, Sean, and good morning, everyone, and thank you for joining us. So the objectives and benefits of the new CSIV regime is to, as Sean touched on, introduce a new corporatized flow-through investment vehicle, and is designed to internationalize Australia's managed funds industry and to attract foreign investment. The regime intends to achieve this through borrowing features from existing international regimes, introducing internationally recognizable investment products, adopting a corporate vehicle rather than the common legal and tax structure of a trust, introducing strong regulatory protections and flow-through taxation benefits for investors, introducing a flexible umbrella sub-fund structure that will enable a CSIV to offer multiple investment products and opportunities and strategies to investors. There's also an ability for these vehicles to be listed and unlisted, and is open to both retail and wholesale clients. Each of these objectives will be discussed further in this presentation. However, we'll now briefly look at some of the international comparatives. On this slide, you'll see 3 examples from the United Kingdom, Singapore, and Hong Kong. The Open-Ended Investment Company, OEIC, the Singapore Variable Capital Company, or SVAC, and Open-Ended Fund Company, OFC, are all examples of currently operating international corporatized collective investment vehicles. We'll now provide just a brief background in relation to each of these. The OEIC, as the name suggests, is an open-ended capital company incorporated in the UK, first introduced in 1997. It is used to pool the funds of investors to invest in equities, bonds, and other securities, and they range in size depending on the demand from investors and are commonly listed and traded on the London Stock Exchange. The OEIC UK market size is expected to grow by 20.5% in 2022. The SVAC is a variable capital company incorporated in Singapore, which can be open-ended or closed-ended and can only be used for collective investment purposes and is commonly adopted for its umbrella structures. This was introduced in January 2020, and by June 2021, there were over 300 SVACs established. And lastly, turning to Hong Kong, the OFC is a Hong Kong incorporated company established for collective investment and was introduced in 2018. It was viewed domestically as a simple, quick alternative to established funds management vehicles that were usually offshore, such as an offshore limited liability company. As part of the continued refinement of this regime, in October 2021, new laws were passed to enable the re-domiciliation of offshore limited liability companies to enable funds management to be reshored in Hong Kong. Treasuries had the benefit of analysing these vehicles with the intention of cherry-picking the best parts of these regimes. For example, and as will be explained in the following slides, the concept of a single corporate director of a CSIV is common with the OEIC, and the ability to segregate assets and liabilities to a sub-fund is common across all vehicles listed. I'll now hand over to Jason to discuss the new regulatory regime.
Thanks, George, and good morning, everyone. So from a Corporations Act perspective, this is perhaps one of the most significant changes that we've seen in the last 20 years. And the reason for that is that, this structure is really quite novel in Australia and doesn't fit neatly within any of the pre-existing frameworks. And so in many respects, it's actually sort of the Frankenstein of corporate structuring, because it takes the features, the good features of a company on the one hand, and takes the good features of a trust and blends them all together. So how does a CSIV work? So we've included up on the slides just a broad overview from a diagrammatical perspective of what it looks like. And the key features are as follows. So a CSIV is a company, so it's a corporatized vehicle, it's not a trust. And so that company has shares. The thing that's unique is each share, each class of share that's on issue is referable to a particular sub-fund of assets. That sub-fund of assets is not its own separate legal entity like you would expect for a trust, but rather it's deemed for tax purposes and deemed for ring fencing purposes, deemed to be a separate vehicle. And the idea really is that it creates sort of an umbrella structure where shares are issued in the one entity, being the CSIV, but ultimately the class of shares are referable to a particular suite of assets and liabilities. And that therefore in turn creates the ability to have sub-funds set up. The other interesting feature of a CSIV is that there's actually no board of directors. There's no management, there's no employees of a CSIV, but instead governments used the UK example of putting in place a corporate director, which is akin to a responsible entity of a registered managed investment scheme. And it's that corporate entity, that corporate director, which must be an AFSL holder, which governs the CSIV. And that corporate director is effectively the entity that makes all the decision making. Again, sort of going back to my analogy of it being a Frankenstein structure, unlike a trust where the trust itself cannot be its own distinct legal entity. In the case of a CSIV, the CSIV is the legal entity. It's the corporate director that just governs the decision making, as distinct to the trust, where it's the responsible entity or the trustee that has to exercise its powers in its capacity as trustee. So that's broadly the overview of the different sort of components that make up a CSIV. George, I might ask you to sort of turn to the next page, and one of the things that we've been thinking about is how a CSIV may be used in different contexts. So I might hand over, Sean, to you to talk about this slide briefly.
Thanks, Jace. I mean, unsurprisingly, when we've started having discussions with various clients about using CSIVs, management are quite keen to know how they will participate in this new structure. So on this slide, we've just got a very rudimentary example of how it might work. A few initial points to flag are that although it's a legal form company that issues shares, for tax purposes, again, we're deemed to be a trust. So that means that if you have a scenario where you've got a manager or an employee that's being issued with a legal form share, that is disregarded for tax purposes. So all of those traditional employee share scheme rules in Division 83A, they are all switched off, even though shares are being issued. So we're not in the traditional employee share scheme world, even though management might be issued shares. We're probably in the world where the individuals are receiving some kind of fringe benefit, I would say. So one example of how this might work is a management co-invest structure where management might be lent amounts, or they might use their own funds to come in alongside the members of each of the sub funds. And I think conceptually there are at least two ways that I could see this happening. Either within sub fund one itself, sub fund one might issue different classes of shares, so that's permitted under the CSIV rules. It isn't, even though each sub fund is a separate class of share, within a sub fund itself, you can have different classes of shares. So you might have one class of shares for your investors and another class of shares in the sub fund for management. And that would all be treated as being in the one deemed sub fund vehicle. Alternatively, you could set up a separate sub fund for management to co-invest through. So, Jace, there are also, I believe, some regulatory considerations for how management might participate in a structure like this co-invest structure. Do you want to just touch on those quickly?
Yeah, look, just very briefly before we move on, is the other interesting thing about this structure is from a disclosure perspective, it's effectively treated as a company, and so you have all of the sort of the benefits of the various exemptions that might apply. Being an exemption from issuing a product disclosure statement or a prospectus to wholesale and sophisticated investors, but also some of the other rules that would apply for smaller capital raisings or for smaller raisings that involve employees, such as retail, staff that might not otherwise qualify as wholesale. And the thing that's interesting there is those exemptions wouldn't ordinarily apply in a trust context. So we actually have a little bit of extra flexibility here. And sort of the reason why we're touching on this is that we're sort of exploring different ways in which this vehicle can be used in contexts that may not have already been sort of thought through as being the primary purpose for which this vehicle is going to be used. George, I might ask you to turn to the next page, and as you do, we've had a question just around the fund liquidity, and the question is, with respect to fund liquidity, is it quarantined to each sub fund or at the overarching CSIV level? The short answer to that is that each sub fund is effectively ring fenced, and and the assets and liabilities of that fund is distinct to that sort of deeming provision. So if there is somebody's investing for a particular fund, those assets, that capital can only flow through to that sub-fund. And we'll touch on the insolvency aspects a little bit later, but the idea really is that even though it's part of an umbrella CSIV, to the extent that there are liabilities, to the extent that there's exposure of a particular sub-fund, and again, that's a notional concept, those liabilities are limited only to those shareholders or those members linked to that sub-fund. And so it's possible to wind up and appoint receivers over and administrators to the assets of that particular class of shares and assets. George, if you can perhaps, so on the establishment of CSIV, what we just want to touch on briefly is a couple of the interesting features of a CSIV, as there's, as I mentioned, a very broad array of changes to the legislation, both under the Corps Act, under the Tax Act, and sort of all the other legislation that hangs off it. So the first point is a CSIV can be established for both retail and wholesale investors. As you would expect, the level of protection and regulatory oversight that's expected in relation to retail CSIVs is far greater, and the best way to think about it is akin to needing a product disclosure statement for retail investors and analogizing it to a registered managed investment scheme where there's a responsible manager. And then for a wholesale CSIV, it's very similar to a wholesale trust from a regulatory perspective. The overarching point, obviously, is that there's a corporate director that will still be needed as part of the overarching structure. The CSIV must have its own special type of constitution, and again, similar to a registered managed investment scheme, where the Corps Act mandates certain types of requirements to be contained in the constitution. The same thing applies here. How sub-funds are established, what are the compliance processes, how you raise funds, how you borrow funds, how you ensure that the assets and liquidity and liabilities are appropriately ring-fenced. In terms of issuing securities, again, the idea is that each class of securities is referable to the sub-fund. As Sean mentioned, it's possible to have multiple classes of securities linked to a particular sub-fund. And it's also possible to have ordinary shares, preference shares, redeemable shares as well. So there is flexibility. We would expect in most instances, if we're sort of talking about a CSIV being used for a fund, that it would be ordinary shares and ordinarily one class of ordinary share linked to the particular fund. But again, whether it's an open-ended fund, a closed-ended fund, that's all possible under this structure. Financial disclosure I've touched on briefly. So I think, just again, broadly speaking, think about it in the context of what you would normally do in terms of the disclosure regime for a wholesale fund versus a retail fund. From an AFSL perspective, there's a couple of things to touch on. So one is the corporate director has to be an AFSL holder, and it has to be a limited company. ASIC released a sort of consultation paper in relation to the process for applying for a variation of AFSL licenses. I understand that those professional trustees and custodians will have been separately reached out, ASIC will have separately reached out to them, encouraging them to apply. As far as I'm aware, and this is a question for any of the attendees who have heard differently or have had different experience. As far as I'm aware, ASIC hasn't yet granted the variations, although the applications for those variations will have been put through. So I would expect that sort of in the coming weeks, those applications will either come through and hopefully ASIC will be sort of processing all of them, if not already done in the background. The level of disclosure, the level of compliance really means that for a corporate director, they need to have a specific authorization to operate a CSIV. If you're an existing AFSL holder who wants to deal in CSIV interests, there's no requirement to vary your license, provided that you have an authorization to deal with securities. But on a go-forward basis, if you're a new AFSL holder who wants to deal in CSIVs, you'll need to specifically apply for that authorization. One of the really important features of the CSIV is around the allocation register, and this really goes back to, you know, the heart of one of the questions that was just raised around liquidity and quarantining. And the reason is because we've effectively got an umbrella vehicle and deeming provisions around ring fencing of assets. It's critically important as part of the integrity of the structure that the corporate director is appropriately allocating assets and maintaining a register of liabilities as it applies to sub-funds. One of the areas that I think is going to be really interesting as a development over time is what happens in an insolvency context where registers haven't been appropriately maintained. Because in theory, whilst an administrator, receivers can be appointed over sub-funds and quarantine those assets, if appropriate registers haven't been kept, I think there's going to be a real issue around ensuring that only those assets that ought to have gone or for the benefit of that sub-fund and its creditors, it's going to be a real issue as to how to navigate those issues. One of the other really interesting features here, and again, I think this comes back to the perspective from an insolvency perspective, is cross-collateralization and cross-pollination of assets. So it is possible for multiple sub-funds to have an interest in the same asset, provided that the asset's divisible. So the common example, obviously, is shares. You know, it is possible for sub-funds to have investments in shares, provided that, again, the allocation register is able to divide it up. But where it's more difficult to achieve that in a property fund context is to have multiple sub-funds having an interest in a real property. And the reason for that is just the difficulty with the divisibility of the real property. Now, of course, there are ways to potentially deal with that, but that's sort of an example of the type of asset where it's less straightforward to be able to allocate a portion of that asset across sub-funds. The other point I just want to touch on briefly again is just in the insolvency context. So we think that, you know, the other sort of legislation that hangs off all of this is from a PPSR perspective. And whilst the PPSR legislation has broadly been updated to reflect a CSIV structure, what I think will take time to sort of develop is, again, in practice, what it will mean where there are multiple claims over those sub-funds. George, I might ask you to turn the page. So I think we've touched on the corporate actions of a CSIV. Again, that's broadly managed by corporate director. In terms of meetings, so even though, again, we're talking about an umbrella vehicle with multiple classes of shares and broadly speaking, a member register, the way in which meetings work is broadly speaking by reference to the sub-funds. So you can have meetings called in respect of sub-funds linked to the particular class of shares, and those decisions made by those class of shareholders will impact the treatment of their assets and the fund that they are investing on behalf of. In terms of the holding of assets, those assets are usually going to be held by the CSIV, or alternatively, again, sort of using a combination of different approaches under the corporate structure or a trust structure, a CSIV might be outsourcing those assets to a custodian. Dealing in shares, distributions and dividends, I think you're getting the idea that again, dividends, distributions flow through to the particular class of shareholder, again, referable to the particular sub-fund. In terms of listings, ASX has also updated their suite of listing rules in anticipation of CSIVs coming live from the 1st of July. The main hurdle there is that at the moment, ASX is only prepared to allow CSIVs which have one sub-fund to be listed. And the reason for that is they are effectively taking a wait and see approach where they want to understand how this new regime will evolve before they jump into allowing multiple sub-funds being listed on the exchange. They've confirmed that from their listings perspective, it will be the notional sub-fund that is the listed entity rather than the listing of the CSIV umbrella vehicle overall. So I think again, it's sort of a wait and see approach at the moment in terms of how that will happen. I don't expect there'll be any real rush to list a CSIV at this stage, particularly while we're sort of waiting on some of these other issues around insolvency, PPSR, perhaps some of the tax issues which Sean and George will talk about as well, being flushed out. Sean, I might hand back to you now on some of the tax aspects.
Thanks, Jace. Just before I pass across to George, I just wanted to make this observation, which is I think the ring fencing of assets and liabilities within each sub-fund trust is really critical to the CSIV regime, because for those of us and our clients on the call who are already familiar with AMITs, there is an ability, and the AMIT rules do allow for the trustee of a multi-class AMIT to make a choice to treat each class of membership as being a separate AMIT, and therefore apply the attribution regime separately to each class. But one issue that I've always or concern I've always had around a multi-class AMIT is about that ring fencing. It seems like a really great idea, which was tacked onto the tax legislation, which with this deeming applying in tax world. But I always wasn't quite sure how legally and from a ring fencing perspective it operated outside of tax. And when we look at the CSIV regime, it really looks like it's like a multi-class AMIT that's been built from the ground up, using with proper thought given to all the different Corps Act and financial legislation that would need to be amended to accommodate the ability to have multiple classes that are ring fenced. So I think if we'll have to wait and see how this plays out in practice, but it certainly gives me more comfort to set up what would be look and feel like a multi-class AMIT under a new CSIV structure, as opposed to under the existing AMIT rules in the tax rules.
Yeah, although I think inevitably, even with this structure, there will be CSIVs that fail. There'll be sort of negative asset market valuations. There'll be sort of experiences where, there's going to be a mismatch of fees, a mismatch of allocations of assets. I don't think the regime really addresses that issue yet. So I think I agree with you, Sean. There's all of the other things have been thought through a lot more carefully in this context. But where things can be unwound, I think the greatest risk is the deeming provision, where you've got one corporate director who has responsibility for notionally, keeping really robust registers. But if that's not done properly, there's going to be a real question as to how you treat each sub-fund from an insolvency perspective.
Thanks, Jace. George, why don't you tell us about how the deeming principle works for tax?
Thanks, Sean and Jason. So building on the concepts that were discussed that were discussed here today, the next section of the presentation will outline what are the key tax features of the regime. So to recap, from a corporate perspective, there is only one legal form CSIV company, and investors are the shareholders in that one CSIV. They hold shares that are referable to a particular sub-fund, which provides for various rights and obligations which are documented in the Constitution. However, each sub-fund is part of the CSIV. There is no separate legal identity. However, from a tax perspective, each sub-fund has a separate tax identity as a unit trust. They have separate registrations, such as a tax file number or TFN, and are required to prepare and file separate income tax returns. As each sub-fund has a separate tax identity as a unit trust, the CSIV now acts in the capacity as a trustee of each of the individual underlying sub-fund unit trusts. And each sub-fund unit trusts hold the assets and liabilities for the benefit of the relevant investors. The investors are deemed to be beneficiaries of each of the relevant sub-fund unit trust to which their shares are referable, and for tax purposes only, are deemed to be unit holders. So for example, on this slide, you'll see sub-fund trust 1 beneficiaries holding units in sub-fund trust 1 with the underlying assets and liabilities. All of the rights, obligations, and characteristics attaching to an investor's shares, as outlined in the Constitution, now attached to the units held by the investors. As the CSIV sub-fund is a unit trust, it will generally receive flow-through taxation treatment, meaning that the shareholders or investors will generally be taxed as if they had invested directly in the underlying assets. Income, exempt income, and non-assessable non-exempt income will retain its character once it's received by the investor. That is, amounts that are attributed or received by the members will not be treated for Australian tax purposes as a legal form dividend paid by the CSIV, and will instead retain their original source and character and be taxed as such. Transactions between each sub-fund unit trust is recognised for tax purposes, i.e. it is not disregarded and there are no grouping provisions. Each of the underlying sub-fund unit trusts can be an ordinary unit trust and taxed under the general taxation law framework, or a specialist unit trust known as an attribution managed investment trust, or AMIT. We'll discuss these in more detail in the following slide. Under the new provisions, there is a deemed fixed trust status for each of the underlying sub-fund unit trusts, and no election is required to become an AMIT. Practically, this means that where a sub-fund unit trust is a managed investment trust, it will automatically be an AMIT. We'll now briefly explore the benefits of being an AMIT. As you'll see on the slide, there are multiple benefits. However, having regard to time, we'll touch on only 3. But before we dive in, it's important to explain at a high level what an AMIT is. An AMIT is a common collective investment structure in Australia and takes the form of a unit trust, where investors hold units and have clearly defined rights with respect to the income and capital of the AMIT. However, a precursor of being an AMIT is that the unit trust must also be a managed investment trust, or MIT. Broadly speaking, for a unit trust to be a MIT, it must be a managed investment scheme under the Australian Corporations Law, operated by an entity holding an Australian Financial Services licence, and meet the widely held requirement and closely held restrictions. So touching on the top 3, as discussed and highlighted before, amounts that are derived or received by the sub-fund unit trust flow to the members, and as such will retain the original character and will not be treated as a dividend unless the amount had the character of a dividend when it was received or derived by that individual sub-fund unit trust and then subsequently distributed to the investor. Flowing from the AMIT regime is the deemed capital account election. So this means that each of the sub-fund unit trusts, which are AMITs, can elect for certain covered assets, such as land, units and unit trusts, or shares in companies, to be treated under Australia's capital gains tax regime rather than on revenue account. And lastly, where any of the sub-fund unit trusts is also a withholding MIP for tax purposes, then the concessionary withholding rules may apply a discounted withholding rate of 15% on distributions, excluding dividend, interest, and royalties. That is, dividends paid by the CSIV to foreign investors will attract not the dividend withholding tax rate. In the next slide, we're going to touch on some of the emerging tax issues. You will note on the slide there are 6 noted. The first 4 revolve around the central concept of the ability to convert an existing structure into a CSIV. From a capital gains tax perspective, there is no specific rollover mechanism introduced in the legislation. This means where fund managers want to convert an existing unit trust, for example, into a CSIV, it will need to consider existing CGT rollovers in order to achieve the desired outcomes. There are no trust loss transfer provisions, which could allow for the transfer of carry forward tax or capital losses from existing structures to a CSIV, and as such are trapped in historic structures. There are no provisions for the transfer of current attribution counts under the CFC regime. This could consequently result in double taxation, where under a historic structure, an amount has been attributed and is then subsequently paid into the new structure of the CSIV. And lastly, in relation to franking credits, broadly, in order to utilise a franking credit, the share must be held for a continuous period at risk of 45 days, of at least 45 days. However, this only needs to be satisfied once in relation to a specific bundle of shares. Now, where shares are transferred from an historic structure to a new CSIV sub-fund unit trust, there will be a requirement to satisfy the 45-day rule again, prior to the ability to utilise any franking credits derived. The next issues deal with questions of, well, how does this new legislation interact with other tax laws, and also duty and land tax? So the new regime specifically states that the deeming provisions apply for all taxation law purposes. There is currently no guidance from the Commissioner nor any courts, understandably, about how this phrase will be interpreted, but on first glance it seems quite broad and extensive. There is only one exclusion noted in the legislation, which is in relation to the Foreign Acquisitions and Takeovers Act, and any legislative instruments made under that Act. The deeming principles also have effect for Australia's double tax agreements to ensure there is consistency between Australia's double tax agreements and the domestic law, such that a CSIV, its investors and sub-funds are viewed in the same way. CSIVs and CSIV sub-fund trusts are specifically excluded from being members of consolidated groups. And for GST purposes, the GST laws apply to each of the sub-fund unit trusts individually. That is, whether there is a requirement to be registered needs to be assessed on a sub-fund by sub-fund basis. You'll need to apply the turnover rules and ascertain whether any of those sub-funds will be carrying on an enterprise. There's also a requirement for a separate registration for GST purposes of each of the sub-fund trusts. And lastly, in relation to duty and land tax, there is currently no guidance on how these vehicles or the sub-fund unit trusts will be treated from a duty or land tax perspective from any of the state or territory revenue authorities. However, we anticipate that this will in time become apparent. I'll now hand back to Jason to conduct the Q&A. Thanks, Jason.
Thanks, George. So, we might throw it open to everybody on the call, and feel free to sort of ask any questions that you might have. Appreciate we've sort of only skimmed the surface in some of the areas, and there's obviously a lot more complexity behind this regime. So feel free to use the Q&A function, and we're happy to take your questions. We've got one from Dan Moat. Dan, good to see that you've joined. Question is usual, interested to hear from Jason on early structuring considerations for CSIVs, is usual in project-based structures to have an investor trust at the top and then one or more sub-funds. We would have a CSIV sub-fund at the top and then unit trusts underneath. So really good question, Dan. And I think that's the way we've been thinking about how that would ultimately play out here as well. And I think that what you've just raised there about having sort of sub-unit trusts is the way in which we'll look to, I think, overcome the idea that you have restrictions on real property being shared across multiple sub-funds. So the way potentially to deal with it is to create a sub-trust and allocating the units in that sub-trust across the different classes of shares in the CSIV, which by definition means that those units are divisible, and it makes it much easier for the corporate director to allocate interests and maintain that register. I think the other reason, and Sean, perhaps jump in here from a sub-fund perspective, it wouldn't impact the benefits of the CSIV from a tax perspective, because in effect the CSIV is looking to mirror the benefits that are already available from a unit trust perspective.
Yeah, I think that's right, Jace. I mean, one of the interesting things I was also going to ask you is, from a regulatory perspective, is there any qualitative or substantive requirement that a CSIV must be a widely held collective investment vehicle, for big ticket items, or is it more flexible than that? And we might see examples of captive CSIVs, for example, where it is this more project to project, perhaps with management participation, where instead of just setting up separate unit trusts every time, you have this one umbrella CSIV, which is captively owned, but it chooses to operate, in effect, sub-funds, and there might be some efficiencies in doing it that way. Do you have any thoughts on that?
Look, I think there's not, as far as I'm aware, any restrictions on it being sort of widely held in the way that you sort of use that colloquially. The idea is that it's possible for a CSIV to be set up with one class of units from day one, with one sub-fund. It can be retail, it can be wholesale. There's no minimum number of investors that need to sit in there. So I think, there is flexibility there. It can be an open fund, it can be closed. So that's why I think, Sean, sort of going back to the discussions we've had in sort of specific contexts as well, I think the CSIV has the potential to be sort of flexible, not just for the use of funds, but for sort of other purposes as well. And sort of time will tell as to whether or not that's sort of embraced.
Thanks, Jace. We've had another question, George. Maybe this one is for you. If I'm a foreign investor and a CSIV declares and pays a dividend, will that be subject to dividend withholding tax?
Thanks, Sean. And that's a really good question. I guess the answer is maybe. It could be. Because as we've kind of discussed today, a CSIV is a flow-through tax vehicle. So if one of its sub-funds receives an unfranked dividend, and this is then distributed to investors, then the dividend withholding tax rules should apply, subject to any modifications or by a treaty. However, as a general proposition, the dividend withholding tax rules will not apply to a dividend declared and paid by the CSIV if no part of that amount reflects a dividend. So if it's merely just a payment of profits, for example.
Thanks, George. So that will indeed be one of the interesting things for investors to get their heads around, which is that what will the distribution statements look like? Because it's a legal form company declaring and paying a dividend that for tax purposes could look completely different. It won't necessarily be a dividend. It'll be whatever was the source of the income that's come up through the relevant sub-fund trust, which will perhaps take a bit of explaining for foreign investors. Another question, George. You mentioned earlier on that in Hong Kong, open-ended fund companies or OFCs have the ability to re-domicile or onshore foreign collective investment vehicles. Is there any ability to do this under the new CSIV regime?
Yeah, thanks, Sean. So currently the short answer is no. And I guess in the Hong Kong example, I guess that was a post-implementation development as well. So currently there is no ability to actually re-domicile any foreign, collective investment vehicles, whether it's an SVAC or OFC, by way of the new regime. But, I do think that if there is, enough market intelligence that funds are being, set up offshore, but, may, be funded and managed in Australia more so. I do think this could be an area that could be developed in the future for sure.
I see a question as well, just from an AFSL perspective, whether or not there's any of the AFSL holders have had their AFSLs varied yet. I also see a couple of attendees on the call here who are sort of professional wholesale and retail custodians and trustees. So appreciate your views as well. But as far as I'm aware, there's sort of just been the ASIC guidance that's gone out as to what's expected. But I haven't, we sort of ran a check recently of a few sort of professional custodians to see if their licenses have been varied, and I haven't seen anything to date. So I don't actually know where ASIC's up to in terms of whether or not they've accepted variations and are having them processed, and that they're just waiting until the 1st of July to make those variations go live, or whether they're still not formally taking any, or formally undertaking any review of those variations. But again, if there's any attendees on the call or on this webinar who have experienced differently or heard otherwise, would be sort of grateful for your input as well. The other thing, just interestingly to touch on, is from a sort of a takeovers perspective. Because it's effectively a corporate, the takeover provisions have been updated to reflect this structure. The way it would work is if it's a listed CSIV, then the sub fund that's listed could be capable of applying under being taken over under the takeover provisions. It's not the CSIV as a whole that's subject to the provisions, it's more by reference to the sub fund. So unless there's any other questions, I think we might look to wrap it up for today. And again, appreciate everybody for joining this morning's seminar. Thank you, obviously, on behalf of Sean, George, and myself and Noah for coming along, and also for all the lawyers who have been assisting us in the background in preparing for today's session, but also for monitoring closely all of the developments. As I mentioned, there is a lot of legislation that hangs off the back of this. There's a lot of complexity, and I'm sure there are sort of many questions that you'll have. So please feel free to reach out to any of us at any time if you've got any questions on the regime more broadly, or the specific circumstances that you want us to explore for your own needs. I think overall, from our perspective, the house view is that this structure really provides a lot of flexibility from a Corporations Act perspective, and also from a tax perspective. But with any new structure, there will be some teething issues. There will be some things that need to be ironed out, and I suspect that once the ball gets rolling, where there's a couple of these vehicles that are actually up and running, those issues will be resolved quickly. So we encourage you to explore it further if it's an area of interest for you in terms of funds that you're looking to set up in the future, or other purposes. So thank you again, and we look forward to speaking to you again.
Thanks, Jace. Thanks, George.
Thanks, everyone.